The risk-free rate. Okay. Well, the risk-free rate is normally calculated by, and I'm just going to go back if I can. The risk-free rate is normally calculated by looking at the risk-free rate in your market, your home market, and the risk-free rate is provided by the cost of debt to the Crown or the government issuing sovereign indebtedness in its currency. So, just very quickly, why is sovereign debt in the local currency? Why is sovereign debt in Malaysian ringgits risk-free rate? Yeah, T-bills are short dated. You'd normally go long dated. You go sort of 5 to 12 years. Long dated. So you've got government bond issues, yeah? Yeah. Okay. Now, why is the government considered to be risk-free when it's issuing Malaysian ringgit debt? What can the government do that no one else can do? Pardon me?
With a good Prime Minister.
With a good Prime Minister. Why is it considered risk-free? Seriously. What can the government do that no one else can do? To charge taxes. Yeah? They can tax people. Yeah? So that's the first thing. What else can they do? They can print money. Okay? They can go and print more Malaysian ringgit to help pay back Malaysian ringgit debt. Yeah? So as a result, as far as governments are concerned, as long as they're issuing in their own currency, that's always considered risk-free. Now, Francis, you mentioned yesterday I think you're a AAA bond issue.
Yeah.
Okay, and so obviously the Malaysian sovereign risk rating is about AAA or AAA plus.
Malaysia is different.
Malaysia's different.
Because it's under the Standard & Poor's is different rating.
Ours
is by local rating agency.
But yours is a local rating entity.
Grandma.
Okay. So what's the Standard & Poor's rating for Malaysia?
I don't know.
Don't know? We'll have to look that up. I'll look it up at lunchtime and come back in. What's Petronas's long-term debt rating issue? I mean, obviously you just issued that massive bond. It wasn't covered in the press. They talked about the amount and everything else. They didn't talk about the rating. Don't know? Okay. Generally speaking, corporate ratings are limited. Corporate ratings are limited to the sovereign rating of the country that they reside in. Yeah? Okay. But the challenge is that governments, when they issue their own currency bond obligations, can print money and they can tax anybody, and as a result, they're regarded as risk-free. And so when we look for the risk-free rate, Francis, what we would normally do is we would look at the capital cycle of your business. So how often do combined cycle gas turbines run out and break and fall over and need to be replaced? Every 20 years?
I think more than the depreciation rate is going to be.
Okay, what you tend to look at in that case is in your particular industry, you try and find a government bond which has got a 25-year duration, and there probably won't be one. In the UK and the US they have things called perpetuals, which are issued permanently, they never repay the principal. Or they're also, in the UK they're also known as gilts, and they're used for long-term capital risk-free rates. In the IT industry, for example, the technology is always changing. You're always going out from one type of cellular network to, say, the 3G network that you're trying to probably roll out 3G networks everywhere, yeah? So they probably have a life cycle of 10 to 15 years. And as a result, you tend to use 10 or 12-year government stock or government bonds to come up with your risk-free rate for those sorts of organisations. Depends on your capital cycle. Again, you think about tankers. I mean, tankers last for a very, very long time, right? Yeah. So the issue is that you need a long-term risk-free rate to come up with an approximation for a risk-free rate. Okay.